Hey, welcome to Everyday Economics, the podcast that helps you learn about the economic world happening around you every day. I'm your host, Chris Krug, president of the 501c3 nonprofit, nonpartisan Franklin Lewis Foundation. Everyday Economics, the production of America's Talking Network. You can subscribe to all of our podcasts at americastalking.com. To support Everyday Economics, please make your tax-deductible charitable contribution by clicking the link in the show description. We are recording this episode on Friday, January 12th. And joining me as always, my partner and friend, Dr. Orphe Divounguy, PhD economist. Dr. O, how goes it, sir?
Hey, I'm okay. How are you?
I'm doing well. Couple of pieces of data that are worth talking about. Of course, the jobs report was out in December. The economy, per the Department of Labor, says that we had gained 216,000 jobs. I have to be honest with you. I did not get into the details on this. I have no idea what percentage of those jobs are government jobs. I have not. So if you want to distill that when we get going here, that'd be terrific.
Yeah, no, for sure. I think that the gains, government, healthcare, some of these sectors, construction is a good thing. Healthcare probably also a good thing because ultimately those are sectors that lagged in their recovery from their pre-pandemic economy, right? And so in an effort to kind of shrink that gap between demand and supply, the increase in supply there, I think is wonderful. It will help to lower prices or price growth in those, for those services. But yeah, the government sector has really been strong. And, I shouldn't say unfortunately, but perhaps unfortunately, these government jobs tend to be high wage jobs. And so that's a good thing for the people who get those jobs. It's wonderful. But at the same time, it pushes wage growth, nominal wage growth higher. And it's a double-edged sword. On one hand, it's good news because lots of people have jobs and they spend more and they have higher wages. On the other hand, higher wage growth raises the risk that this inflation could slow. And basically has kind of stopped the decline in yields, right, or interest rates that we saw in December and that people were expecting to continue at the start of this year.
Right. So yeah, I didn't want to dwell so much on the jobs and the job numbers as much as I'd like to talk about consumer price index, and that number came out. Yesterday, we're recording this on Friday, January 12th. The data came out on the 11th. The consumer price index increased 0.3% in December. It's from 3.0%.
Yeah, year over year, from 0.1% month over month in November, right? So you see this uptick.
That's where I'd like to drill down. So can we talk about that and what that means? Well, I think when people see these numbers and the percentages are relatively low, then it's like, does that mean anything? It does.
Yeah, it does. It does. Of course. I mean, you think about it, the 0.3% per month, right? Imagine if inflation were to continue like that for the rest of the year, then we'd be way above the Fed's 2% target, right? So you got to think about annualizing these monthly changes. And so headline CPI, consumer price index, actually increased more than expected. And so you see this acceleration in price growth in December. Again, I think on this podcast, we had basically already kind of predicted this would happen. I remember back in November, I said, look, financial conditions are easing so much. They've eased so much. You start to see interest rates decline a lot, and that gives the consumer a little bit of breathing room. Now, core CPI was stuck at 0.3% December, the same increase as in November. So consumers maybe are not out there as much more than they were in November. In fact, when you look at the current activity indicator published by Goldman Sachs, it shows basically that December was slightly less hot than November, right? There was still an increase, but slightly less of an increase than November. And so activity is continuing to slow, right? But you got commodity price shocks. In fact, the hotter than expected CPI came from a big jump in energy prices in December, right? The energy index rose 0.4% in December after decreasing 2.3% in November. And so the electricity index increased 1.3% over a month. So huge increase in energy prices in December had a lot to do with that.
What about the shelter costs? I mean, if you pull this report apart, and I'm reading directly from Jeff Cox's story at CNBC, which he published yesterday. He's got a paragraph in here that says much of the increase came due to rising shelter costs. The category rose 0.5% for the month and accounted for more than half of the core CPI increase. And on an annual basis, he wrote, shelter costs increased 6.2%, or about 2/3 of the rise of inflation.
That is correct. Now, there's much that unfortunately the public doesn't know about shelter costs. And that is the fact that the shelter cost in CPI, at least the rent components of shelter in CPI are basically survey, right? And so they reflect, what do they reflect? They reflect, they come in lagged. In other words, when people move, people move every year or so. And so when people move every year or so, if you take a survey, you're only capturing not all of the movers that moved. And so if rents have come down a ton, right, you're not capturing some of these movers that are now facing much lower rents than they did. So market rents have actually cooled significantly from their peak back in February of 2022, and they're down to around the 4% mark for single family rents, and even further down on a year-over-year basis for apartment rents. And so of course the owner's equivalent rent or rent of primary residence in the CPI is not going to pick this up for a while, right? It shows up usually with 12 to 18 month lag. And so we're going to continue to see, even though it's still up in the CPI, people on the streets are not facing, renters are not facing these higher rents. And so if you account for the fact that renters are actually now facing much, rent growth has slowed so much, and now renters are not facing the type of rent growth that they were facing before, then the CPI would have come in at about 1.9%. All right. So much lower than the figure that's out there right now, and also lower than where the Federal Reserve Bank would actually wants inflation to be. And so you replace that with actual rents, and you realize that the economy actually has cooled significantly, and the price growth has slowed down a lot. And basically that it's going to show up eventually in the CPI numbers. It just hasn't yet. Now, of course, there are concerns. There are concerns that maybe market rents could be picking up again, right? In a month of December, rent growth in November had continued to slow. In the month of December, rent growth picked up a little bit. Market rent growth picked up a little bit on a year-over-year basis.
Right.
And so the question is, picked up. I shouldn't really say picked up. I think it pretty much kind of like stopped slowing, right? It just stabilized, right? Okay. So rent growth has really stabilized. Is not coming down all that much anymore. And so the big question is, will we see, how long will it take for CPI to catch up? And the second thing is, could we be seeing an uptick in activity and rents in the new year? Because remember, a tight labor market is linked to more mobility. if people are moving more, because if people are experiencing higher wage growth because the labor market's still very tight, and the wages are rising really fast, then more people will tend to move out on their own, right? And you'll see an uptick in housing market activity, not just on the for sale side, but you also could see rent growth picking up again. And I think that is the concern, is that if interest rates continue to decrease, if financial and credit conditions ease, if the labor market remains very tight as a result, then you could see higher rent growth again, right? Rent growth gaining steam again. And that could delay this inflationary process tremendously. So that kind of sums up. Remember, housing costs make up 42% of core CPI. So very important then that housing costs continue to ease into 2024.
Appreciate your thoughts as always. For Orphe Divounguy, this has been Chris Krug. Subscribe to Everyday Economics and dozens of other high-quality podcasts at americastalking.com.
Audible is a great way to gain access to an ever-growing selection of audiobooks. They've got what everyone's listening to: bestsellers, new releases, that story you've been waiting for. Follow the link in our show description to get 30 days of Audible free.